Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week's episode is number 77. And on the podcast this week, I talk about inflation. We had a little bit of a surprise inflation number come out from the Bureau of Labor Statistics last week that spooked the markets by just a little bit. We had a couple of consecutive down days, and I wanted to spend this week's podcast episode talking about inflation, talking about what it is, why it happens, how we measure it, and how we might think about investing in an inflationary environment. This is something that I think we all may have experienced over the last year, but may not know exactly what to do about it. And I thought it might be helpful to share a few thoughts on structuring a portfolio in such an environment and hopefully shed some light on an issue that doesn't get a whole lot of discussion. I hope you enjoy it. All right, so this week on the podcast, we're talking about inflation. And the reason that I wanted to cover inflation this week specifically is because we had a number announced by the Bureau of Labor Statistics last week that was a little bit higher than I think the markets and perhaps the Federal Reserve and a lot of people around the country really anticipated. And I thought this would be a good opportunity to just chat about what inflation is, why we care about it, how we measure it, why it's important in monetary policy decisions at the Federal Reserve, and what we might think about as investors in terms of constructing a portfolio in an inflationary environment. But before we launch into it, maybe one housekeeping item and then more of an admission. First, I guess the admission. So this is the second time I've recorded this episode. I recorded it earlier in the day, and I thought I've become pretty good at handling the technology involved in these podcast recordings. This time I made a mistake and recorded it using the audio on my desktop computer, which sounds really crummy as opposed to the audio through my headset and microphone here. So the quality of it was really bad, and I'm now having to re-record it on a Friday afternoon, which is not that big of a deal because it gives me a second opportunity to kind of do a dry run and maybe put my thoughts together a little bit better. So just thought I would share that because that does happen from time to time still here, even though I think we are getting pretty proficient at creating and producing these new episodes. Now, housekeeping item. We're going to talk today about investing in an inflationary environment, how to structure a portfolio, how we might think about this if you're concerned that inflation is around the corner. That said, I think forecasting whether inflation is going to be high or low or negative in a deflationary environment, I don't think that is a fruitful exercise. As you know, we don't want to guess what direction the stock market is headed over the next 3, 6, 18, 24 months. We also don't want to try to guess what economic statistics are going to do because it really comes down to a coin flip. And the smartest people in the world, just as the smartest stock market strategists, are unable to predict what direction the market's headed over the next few months or even couple of years. Economists argue over what direction inflation is headed. And if we make investment decisions based on our personal thoughts around future inflation, it is likely to lead us to a bad outcome, in my opinion. So we'll talk about this. It's something that I think is important to everyone around the country. I would guess that just in the last 12 months, you've seen some prices rise in stuff that you buy in a given month, and you've witnessed this inflation firsthand. But that said, I don't think that we should make adjustments to investment portfolios or substantial adjustments directly because of that, because inflation could go back down next month too. We really don't know. But let's start this episode by just reviewing what inflation is and how we measure it and why we care about it. And in general, inflation has to do with the value of the U.S. dollar. And we in our working years, in our careers, we earn US dollars unless you're like a professional athlete and have compelled your organization to start paying you in Bitcoin, like some NFL players are doing, as I understand it. But most of us get paid in dollars. And so, we go to work to earn money to feed ourselves and our families and to put money into savings so that we can stop working at some time before we keel over and die. And so we're transacting in fiat currency, which is basically paper US dollars. In other words, that's not backed by gold or anything else. And so inflation is when the prices of the goods that we buy with those dollars go up. And if you think about it, the other side of that, the other way of expressing inflation is when the value of those dollars go down. And if you think about your economics 101, supply and demand, you have supply and demand curves kind of go like this. For those of you who are listening and not watching, I look like a fool in the video here. I have my arms up in an X. But the idea is when money is easy and when people have a lot of money, but the number of goods and services in the economy hasn't changed, the price at which those goods and services are exchanged, the market price, tends to go up because the same number of people are chasing the same number of goods. They just have more dollars in their pockets to pay for them. And in a competitive market, when the money supply goes up, prices tend to go up as well to meet that equilibrium point. Now, it's a lot more complicated than that in real life, but that's the idea. Prices of the things that we buy with our dollars go up, meaning that the value of the dollars that we hold go down. Now, there are a number of ways that we measure this, and inflation measures they catch a lot of heat in the media, and one really common misconception is that we should not pay attention to inflation statistics because the numbers omit food and energy. And that's not exactly true, as it turns out. And so the way that we measure inflation is the Bureau of Labor Statistics has a big team of people. It's a government-sponsored agency, and they track what it costs to buy a similar basket of goods, which consists of stuff that you and I buy on a monthly basis in various areas around the country. And so I don't know how many regions that there are around the country that they track, but the idea is they're looking at housing, they're looking at food prices, energy prices, entertainment, utilities, anything that the average consumer spends money on in a given month. They're tracking the prices of every single month. And then they build each of these regions into a composite index to track prices across the country on an ongoing basis. And so the number that came out last week that indicated that inflation was a little bit higher than we were otherwise expecting was that the price of that basket of goods and services compared to in April of 2021 compared to April of 2020 had gone up by 4.2%. And that's a large jump in prices. And I would guess that, if you're listening to this and you're thinking, well, yeah, I've noticed that. I mean, my grocery bill is higher. Just the price of everything that I want to buy has gone up a little bit in the last 12 months. And that's been my experience too. The housing markets are on fire. It's expensive to buy new cars, used cars right now because there's a little bit of a shortage in chip manufacturing. Our grocery bill at my house has gone up a little bit, but I guess we do have 3 young kids in my house, and they're eating a lot more right now than they were 12 months ago, so that has something to do with it. But anyway, prices are going up. And so the Bureau of Labor Statistics tracks this basket of goods and services each month and then compares it to the same month from the previous year to give us a sense of where inflation is headed. And so the common gripe is that, that index doesn't include food or energy. The consumer price index, this composite I'm talking about, has different flavors of it. There are several different consumer price indices that the Bureau of Labor Statistics comes out with. One of them is called the core index, the core CPI. That measure of inflation indeed does not include food or energy costs. And the number for April 2021 compared to 2020 was an increase of 3% year over year. And so you compare that to what's called the CPI-U, or the Consumer Price Index for urban, I think they call it urban dwellers or urban citizens or something like that. But the CPI-U does. And so the CPI-U that includes everything, including food and energy, is up 4.2%. The core CPI is up 3% year over year. Now, if you're interested in this stuff, go to bls.gov/CPI, and they have a nice interactive chart where you can compare the two. And so I'm looking at this on my other screen right now. And when you look at the CPI-U, it's up 4.2%. They have the core CPI, which they label as all items less food and energy, is up 3%. But then they break it down into how much energy and food costs have gone up over the last year. And according to this chart, food prices have gone up 2.4% year over year. Energy prices have gone up 25.1%. And that's both gas and oil. So I'm sure, unless you have an electric car and haven't been to a gas station or paid attention to what the numbers are on the signs at all, you've probably noticed gas prices have gone up quite a bit in the last year as well. And so the CPI measure that most people should pay attention to, the urban dwellers, that includes food and energy, is up a little bit more, and that's largely the difference between the CPI-U and the core CPI is predominantly driven by rising energy costs, which is really interesting. So it's a little bit of a misconception there, and I say that because some media publications will focus on the core CPI, but the metrics that matter, or the organizations that matter, are like the Social Security Administration. So when our Social Security benefits are increased each year based on cost of living adjustments, those cost of living adjustments are based on CPI-U that does include food and energy. Treasury inflation protected securities, Treasury bonds that whose interest adjusts with inflation, are determined, that inflation adjustment is based on CPI-U, not core CPI. Different tax code parameters, like our standard deduction, the brackets themselves, retirement plan contribution limits, all those items go up by a little bit every year or every couple of years. The amount that they go up is based on CPI-U, not core CPI. So a lot of people will kind of dismiss CPI data entirely and throw the baby out with the bathwater because they've heard that, well, it doesn't even include food and energy prices, we shouldn't pay attention to it at all. And that's really misleading. So that's the way that we track it. And the CPI is one measure of inflation. It's not the only measure. We also have indices that the Bureau of Labor Statistics tracks, like the Producer Price Index, PPI, which is more relevant to businesses, both of which, the PPI and the CPI, are really pretty closely tracked by the Federal Reserve when they institute monetary policy. And that's really why I wanted to dive into this topic today, because inflation is tracked very, very closely by the Federal Reserve. And the Fed's actions and the tools they have in their toolbox are deployed primarily to keep inflation under control. So remember why the Federal Reserve exists. It exists for two reasons. They have a dual mandate, the first of which is to promote price stability. And that's the most important thing that they do. That means that we don't want the value of our dollars to fluctuate wildly. And on the one end, you can have inflation run out of control and create hyperinflation. You probably remember pictures in your history books about what Germany was like after World War I, when they were experiencing hyperinflation in their currency. That's bad for all citizens, basically. And what it boils down to is you have to, if you go to work and earn a wage that's paid in a currency that's in a hyperinflationary environment, you have to get paid every day and take your wages and go to the market and buy bread and eggs and milk and all the stuff that you buy. Because if you stick that cash in your pocket and wait one day and go the following day, it's not going to be enough to buy what you need because the value of the currency is going down so rapidly. That's obviously bad. We don't want that. But on the other hand, we don't want deflationary pressures either, where the value of the dollar goes up by so much that prices of what we buy in a given month start falling. That's really bad. And you might think, well, that might actually be pretty nice because the money I have saved in the bank would get me a lot further throughout the month. It would buy me a lot more stuff. And that's true. But the other side of the coin there is that when prices fall, businesses are not able to sell their goods and services for the same amount that they were before, and they have to start passing pay cuts down to their employees. They have to start laying people off, and it's really, really bad for the economy in general. And so those are the two extremes. And what we want, and what is good for you and me and the rest of the citizenship across the country, and what is good for our economy, is a stable rate of inflation, a little bit above zero. Economists like to have slight inflation year by year, and the target, and what most economists agree is a healthy measure, is about 2% per year. So that's what the Federal Reserve is shooting for, is 2% inflation per year. And that's the first reason that they exist, is to promote price stability. And that's currently their target. The second reason they exist is to benefit the economy and promote what they call full employment. And so if they're doing their job and prices are stable, things are going well, their next focus is to use the monetary policy arrows in their quiver to promote full employment and assist economic growth. And the tools that they have access to are they can change the level of short-term interest rates, the Fed funds rate, either higher or lower. They can adjust the discount rate, which is the rate that banks charge each other to borrow and lend deposits. They can adjust reserve requirements, the amount that banks are required to hold, or the percentage of deposits that they're required to hold. They can also engage in asset purchases, debt monetization, which we're doing right now through quantitative easing. So the Federal Reserve is going out there and buying U.S. debt and building a balance sheet of it in exchange for U.S. dollars. And so there's all these monetary policy tools the Federal Reserve uses to meet those objectives. Fiscal policy is what comes out of the executive and legislative branches of government. And as you well know, we've had a lot of federal government spending here over the last 15 months directly related to coronavirus stimulus. And so the fear with accommodative policy, both fiscal and monetary, is that too much money flows through the banking system and the supply of money goes up by enough to create inflation. So remember back to the Economics 101 supply and demand curve. If the amount of US dollars in circulation goes up, and those US dollars are meant to buy the exact same amount of goods and services across the country, that means that the prices of those goods and services are going to go up because there are more dollars available to be spent on them. And right now we've had a couple rounds of stimulus checks been just printed out from federal borrowing basically, and being sent to U.S. citizens. We have asset purchases that the Federal Reserve is engaging in. We have very low interest rates, which means that money flows through the banking system. The velocity of money increases, and which boosts the supply at a faster rate. So we have several different angles of money supply being increased. And since the mortgage crisis in 2008, it's really been this way, aside from the more recent fiscal stimulus coming from the White House. We've had very accommodative monetary policy since 2008 and 2009. That hasn't really changed a whole lot. But it hasn't resulted in inflation yet. And the fear is that all this money, whereas it hasn't resulted in inflation yet, will all of a sudden kind of catch up to us and result in inflation so rapidly that the Federal Reserve won't really be able to control it. And if they can, it'll be by raising interest rates very dramatically and have a terribly negative impact on the capital markets. That's the fear. We haven't really experienced that yet until this last week. And to be clear, the numbers that came out last week aren't terribly alarming or scary or anything like that. We're just seeing an uptick in inflation for the first time. So that's caught the attention of the markets. And we had stock prices fall in a couple consecutive days, which hasn't happened in a little while. We have commentary from the Federal Reserve. Basically, the chairman came out, Jerome Powell came out and said that their opinion is that that inflation number is transitory, quote unquote, and will not persist. We don't know, and only time will tell. There are a lot of arguments on both sides over whether that will occur or not. But it seems to me that the trigger, maybe the straw that broke the camel's back here, could have been this most recent round of stimulus and the amount of cash payments to citizens through the stimulus checks, because that's a direct increase in M2 money supply. So those are the dynamics. It freaked out the stock markets there temporarily. Today and yesterday were both up days, so it hasn't been too much of a scare across markets, but it has the investment community maybe raising an eyebrow, taking a closer look at how this will play out over definitely the next couple months, and certainly beyond that too. So that's the background. That's what inflation is. That's why we care about it. Obviously, if prices start running out of control, that makes things more expensive for you and me. It means that we need to get paid more for our work to keep up with that. It means that the savings that you have in the bank are not going to be worth as much. And as investors, it makes sense to review how this impacts different asset classes. So again, I don't think that it makes sense to make adjustments to an investment portfolio because we saw a higher inflation number this last month than we've seen in a while. If you're someone who wants to structure a portfolio around this concept of potentially mitigating inflationary pressures, that's possible. But at the same time, it could be transitory, as the Fed chairman says. It could persist. We don't know. The path to the best outcome, and I'm probably sound like a broken record here, is a long-term, consistently executed strategy throughout all environments, and that is not going to change based on a number that comes out one week and causes a couple days of sell-offs. So let's review how inflation tends to impact portfolios. And what I'll do here is go asset class by asset class and just kind of share some thoughts. And the first one that we'll start with is equities, because that's probably the asset class that you have the largest portion of your portfolio in. For most people, we have a lot of clients with more bonds than they do stocks because they're more conservative, and that's totally okay too. But we'll start with stocks nonetheless. So stocks actually hold up really pretty well in most environments that are seeing inflationary pressures. And the reason is that if prices of the stuff you and I are buying and businesses are buying go up, a stock is just a portion of ownership of a publicly traded company. And if you think of the income statement of a corporation, they have revenues that come in at the top, and then they have the cost of their goods underneath that, and then they have other operating costs, debt service, taxes, and then they have profits that are left over after all those costs at the bottom of the income statement. And so if the cost of the goods that they're buying go up because of inflation, And if labor costs go up and other costs go up, it reduces profitability. But equities are really pretty well equipped in most circumstances to pass those cost increases on to their own customers and their own clients. And so because of that, if we see inflation and the cost of if you're someone who buys boulders and then sculpts them into sculptures and the cost of boulders goes up, well, you can just charge more for your sculptures and pass that down to the people buying your goods and services. So equities have historically been really pretty strong inflation hedges, but there is a difference between value and growth stocks because of tenure and pricing power. And so if you think of like an Amazon or a Netflix, very as growthy companies really as you can get, Amazon, if they're going to raise the price of Prime memberships by $10 tomorrow, they ain't going to have a problem selling Prime memberships. It's an exceptionally popular service. People around the world love using it. They're not. It might cost them some subscribers, but it would probably be a net positive to them. They have no problem raising prices and passing inflation through to their own customers. Same with Netflix. Every once in a while, Netflix bumps up the cost of their monthly membership by a couple bucks, and they're easily able to do that. They don't have too many people canceling their membership over a $2 increase per month. Now, on the other hand, well, Apple is another wonderful example of that. Apple, if the cost of chips go up, computer chips, they can just charge a little bit more for their phones and laptops because they have pricing power. People love the product and service. But look at other value companies. Think of like Procter and Gamble, maybe. If the cost of their stuff goes up, they don't have as much pricing power, and a lot of value stocks do have a lot of brand loyalty. Maybe Coke is a good example of that. But they're more commodity type goods and service, more commoditized businesses. And because of the nature of a value stock, it's more of a cash cow. You're buying it because the earnings are cheap. There's not a whole lot of innovation and new technology that's going to drive revenue growth. You're kind of hanging on to the earnings stream that already exists. They tend to have less pricing power. And if you look at, there are charts and papers out there that have looked at the performance of growth companies versus the performance of dividend-paying companies in inflationary environments. Growth companies tend to do better because companies that pay a dividend, they just aren't able to pass those price increases on. So that's something to think about. Something else to think about there is, and I don't have any papers or studies here to reference, but if the value of US dollars is going down, then it seems to me that you want to make sure you have a healthy allocation to international and emerging market stocks that are not domiciled here in the US. And yes, large corporations abroad absolutely do have exposure to US dollars, but Volkswagen, based in Germany, is going to have more exposure to the euro than they are US dollars. So international, geographic diversification helps there too, because exposures to other currencies dilutes the degradation of, dilutes the impact of the degradation of US dollar values. Bonds are a different animal. In a bond, you're lending money to another party, federal government, state government, local government, corporations, any other party. They may pay you interest every 6 or 12 months, and then at some date in the future, you probably get your money back. Some bonds are issued in perpetuity, preferred stocks at least are issued in perpetuity. But let's stick with a bond that matures, let's say in 10 years, for example. Well, if you lend $1,000 to the U.S. government by buying one of their bonds, you collect interest every 6 months, and then at the end of 10 years, you're going to get that $1,000 back when the bond matures. Well, if inflation kicks up, the value of that $1,000 you get back in 10 years is going to go down by quite a bit. So bonds do not hold up well in inflationary environments. This is another case for non-US bonds. You want to have assets with different risk profiles in your portfolio to use the benefits of diversification to your advantage. But you might not want everything denominated in US dollars, especially in an inflationary environment. Now, that said, there are US dollar denominated debts out there that work pretty well in inflationary environments. Treasury inflation protected securities, TIPS, are one of them. And the idea is if you're lending money to the government, so they're issued by the federal government, you buy one of their bonds and you get this interest every 6 months. The amount of interest that you get depends on CPI. And again, not the CPI, the core CPI that excludes food and energy, the CPIU that includes all the relevant costs. So if you buy the bond and inflation does tick up and the value of that $1,000 you're going to get in return goes down, you're going to collect more in in interest between now and then to make up for it. So that is an asset class that does well in inflationary environments because it's meant to protect investors from that risk. You can also consider bank loans, leveraged loans. So banks around the country will lend to individuals, small businesses, other corporations, and then they'll package up those loans and issue them through like a mutual fund or an ETF or other private placement type products. That works pretty well because those bank loans are variable rate. Usually they're tied to like LIBOR, London Interbank Offering Rate, prime rate, or some other widely used market measure of interest rates. So if inflation ticks up and it forces the Federal Reserve to raise interest rates, you'd benefit from that because that interest rate change is passed along to borrowers on the other side of your loan. So when inflation goes up, that's a reasonable asset class to be in. That said, leveraged loans are a very risky animal. And because of the credit riskiness, the creditworthiness of the borrowers that banks are lending the money to, you're going to have more defaults too. So you get more interest in the first place because they're risky. If interest rates change, you'd experience that change as well. But just know that it's not like another type of U.S. government bond. It's not like a highly rated corporate bond. It's far riskier than either of those asset classes, and it's very commonplace that in poor economies, bank loans really struggle because they have defaults in the underlying portfolio. Same goes for variable rate preferred stocks. Preferred stocks are an interesting animal. The formal name is a preferred stock, which means it is a share of equity. You may or may not have voting rights in that equity, but it operates just like a bond. You buy this thing either from the corporation itself or on the secondary market from another investor. And most, if not all, preferred shares pay dividends and are required to pay dividends, I should say. Whereas if you own a share of Apple can cut that dividend whenever they want. If you own a preferred stock, the issuer cannot change the terms of that dividend. And in the preferred market, most are issued at fixed rates. Some are issued at variable rates. So there's an ETF out there, I think the ticker is VRP, that tracks an index of variable rate preferred stocks, which is a reasonable asset class to consider if you're worried about inflation. Because again, if interest rates tick up to battle inflationary pressures, you enjoy that through more interest in your preferred shares in your portfolio. Like bank loans, these are a risky asset class. And the reason is that it's technically a debt instrument, but it's subordinate to other types of corporate debt. So if Apple has corporate debt and preferred stock, and you own the preferred stock, if they ever run into trouble and have to liquidate and go through and are maybe seeking bankruptcy protection, the courts are going to force them to liquidate their assets and pay off all debts that they possibly can. And bondholders get paid before holders of preferred stocks. So when you have bad economies and recessions, and you have a lot of corporations going through that and facing, restructuring and other challenges, it's really common that preferred stocks lose a lot of ground because the entire value of your preferred stock just gets wiped out, just like stockholders. So it's kind of like a stock, it's kind of like a bond, which is why they have the label preferred stock. And I think in like 2008, 2009, the preferred stock index fell as much as 50%, I believe. So it's not something to be taken lightly, but it is something to consider if you're making adjustments to your bond portfolio to battle inflation. Now, needless to say, if you have a substantial amount of your portfolio in bonds and you're trying to rejigger that portfolio, that bond allocation to prepare for inflation, don't stick it all in variable rate preferreds and variable rate preferreds and leveraged loans. That's the risk profile of your bond portfolio is going to like quadruple, which kind of defeats the purpose of being in bonds in the first place. But again, something to consider. Now, last thing I wanted to mention here are real assets. Real estate is a really good asset class to be in because if you, like your own house, if you use dollars to buy a house and then the value of US dollars goes down, your house is the house. And if you wanted to sell 10 years down the road after the value of the dollar declined, well, then you just put it on the market for more US dollars and raise your asking price. Same goes for gold, oil and gas reserves, and there are other commodities that, well, most commodities really, any real asset tends to do pretty well in inflationary times. I'm not a huge gold bug per se, but I do like the real estate play through real estate investment trusts and personal real estate holdings. Now, last thing I'll mention here is that it's kind of a unique time because interest rates are super low. We're starting to get a sniff of inflation. And if you're someone who's, considering buying a house or maybe taking out a second mortgage to, put in a new kitchen or something like that, it's really not a bad time to borrow a bunch of money. And I almost feel reckless when I say that as someone who's has a background in financial planning. And so make sure that you're, comfortable with the risk of doing that and can make the payments and, are not getting out over your skis. But if we're concerned about the value of the US dollar going down, remember, we don't want to be long a whole bunch of fixed rate debts. It could be advantageous to be short a bunch of fixed rate debts. If you borrow $100,000 through a second mortgage to put in a new kitchen, and the value and $100,000 5 years from now is going to be worth a lot less than it is today, could be a pretty good play. And you're putting money into your house, which is itself a pretty decent hedge against inflation. So thought I would mention that because real estate itself and all hard assets are really pretty good places to be in inflationary times. And it's also, not bad to be to borrow money that's where your paybacks are not going to be worth as much in the future. So that does it for today. I hope this was interesting and made a little bit of sense. It's an issue that I think we're all probably experiencing, but haven't really seen economic numbers that match what we're noticing intuitively at the grocery stores and the gas stations and around our local communities. So I hope this was helpful. We have a really good guest in line for next week. I'm excited to speak with. And I look forward to talking to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.